Hey everyone, I hope you are having a great day today. Now, I want to talk about how much inflation we can expect in next 20 years, right? So inflation, first and foremost, is a function and a consequence of printed money, right? So we need to see how much money needs to be printed over the next couple of decades, and that how much inflation it will cause, right? Do we have a benchmark telling us how much inflation you will have, for example, for every trillion dollars printed, right? And what I'm going to do over this presentation is to use some very favorable assumptions. Why? Because I just want to get the base case or the best case essentially, okay? And when you know what is your best case, what is the least inflation that you will have, then then you can add to it whatever scenario you want, and get maybe what is more realistic to you, right? So in any case, I want to make some very favorable assumptions because I want to see what would be the least inflation. Okay. All right. So first question: how much money needs to be printed, or next couple of decades? So the money needs to be printed to pay off the debt, right? That's that much at least has to be printed. Of course, if you have, I don't know, maybe another pandemic, or if you have an economic crash, or if you have a war, God forbid, then you have to print more money, of course, right? But at least you have to print money, to pay off some of your debt. And if you assume that nothing else will happen, you have some debt that you have to, you will have to monetize, right? So our debt right now, U.S. debt, as of now, is about 31 trillions. And so to figure out how much money needs to be actually printed to pay off this debt, we have to break down this debt. Okay, so I'm breaking it down to three different categories. All right. First category is uh, first category is the government debt to itself. All right, so that would be how much the government owes to Federal Reserve Bank, or how much it owes to Social Security. Now, though all of these institutions, they are part of the government, right? So, you can argue with it, but like I said, I'm gonna make some favorable assumptions, right? So I'm gonna assume that government debt to itself, it means taking it from one pocket and putting it in another pocket, and it's not gonna be really printed. Again, you can argue with that. There are plenty of people who can argue with that, but I'm just gonna make some very favorable assumptions here. All right. So this is the first part of debt. Second part is the government debt to actual U.S. person or a U.S. institution. Okay, that would be whoever who owns some treasury bonds or bills or notes. That would be a bunch of hedge funds, a lot of pensions, right? Some individuals, you and I, etc., etc. A lot of people, a lot of individuals and institutions inside U.S. government owes them money, and that comes up to $12 trillion so far. All right, so this actually has to be paid off at some point, right? All right, now this is the second. Now, third type is the government debt, U.S. government debt to foreigners. And that would be to China, Japan, UK, some foreign pensions and hedge funds, and that comes up to $7 trillion. Now I'm going to make some assumptions here. First, that I'm going to assume that debt will not increase. Now, of course, this is very easy to argue against. As I'm recording this, we are talking about another $2.5 trillion increase in debt ceiling. So, in any case, today I feel generous. I'm just assuming that we are not going to print. No, we are not going to increase the debt. So the debt, I'm assuming that it's going to stay $31 trillion. All right, great. Now, the other one is that I'm going to assume that government debt to itself doesn't count. That means that this $12 trillion, I'm assuming this doesn't count. And I already talked about it. Now, third one is that we have a bunch of debt here, in this category to foreigners, right? And this, for it to be monetized, we will print dollars, and give it to those foreign entities. And it's very hard to figure out how that will impact inflation inside US, right? I mean, you can look at our imports, right? If we print this much dollar and give it, give it to foreigners, of course that's going to, bring down the dollar index, right? And then that means our imported goods are going to increase in price. But how much, we don't know. We don't have a really real benchmark. Of course, maybe you can look at the size of the imports versus the total, consumption of goods and services by us, and you can say, okay, that portion will have inflation due to monetizing this $7 trillion. You can look at it maybe a couple of ways, but it is going to be not straightforward, right? So what I'm going to do, I'm going to assume that printing this $7 trillion and monetizing this debt, it's going to impact us as much as printing $3 trillion and giving it to U.S. entities. Okay, so I'm assuming that this $7 trillion will impact inflation, as if it was $3 trillion owed to U.S. individuals and institutions. Okay. Again, that's another favorite assumption. So you can argue against it, and so on and so forth. But I'm just assuming that. All right. So in that case, the portion of debt that needs to be absolutely monetized, means that needs to be absolutely printed out, is the summation of these 12 trillions plus these 3 trillions. That would add up to $15 trillion. Right. So this much money needs to be printed. Okay. To pay the debt. All right, now over what period exactly? So for that, we need to look at the duration, the average duration of US debt. So the average duration, the weighted average duration of US debt is just over 5 years. Well, let's say 5 years, okay? So that means roughly the debt, that $31 trillion of debt, right? It has to be paid off between 0 to 10 years. So it has to be paid off, gradually, up to 10 years. Okay, roughly. Okay, roughly. I'm gonna make another favorable assumption. I'm gonna say it's 20 years. Okay, I'm gonna say, okay, I'm going for a best case scenario, very nice scenario, and I'm gonna say that the debt has to be paid over 20 years. Although, in reality, it is more like 10 years. Okay, great. All right, great. So we have to print 15 trillions over 20 years. Okay, best case. All right, how much inflation is it going to cause? Do we have a benchmark for that? Yes, we do, thanks to COVID. Before that, we didn't have. So during COVID, we printed $5 trillion, right, and gave it out, and that caused so far about 25% inflation, maybe slightly more than that, right? And I'm going by real inflation. Okay, I'm going by a real number. I'm not gonna go by CPI, which is government measures of inflation, and somehow only with government measurement, by U.S. government measurement, the inflation is, it has been about 14% over the past couple of years. If you look at everything else, import prices, export prices, average annual, price of gold, for example, a bunch of other measures that financial institutions and use to measure the real inflation. If you go to grocery stores, you know what I'm talking about. If you're paying property taxes, you know what I'm talking about, right? The real value inflation, so far it looks more like 25%, maybe slightly more. In any case, so the 5 trillion that we gave out and we printed and gave out after COVID-19, it caused about 25% inflation. All right, so if that's the case, now this $15 trillion that we have to pay we have to pay, we have to print over the next 20 years. It means that we are going to have at least 3 more episodes of high inflation, just like what we had over the past 2 years, over the next 20 years. Let me repeat that. So 15 trillions is 3 times 5 trillions, right? We have to print this. At best, at minimum, we have to print this much over the next 20 years, right? This is the best case with very favorable assumptions, right? We have to at least print 15 trillions over the next 20 years, right? To monetize our debt, right? So that means we're gonna have at least 3 more episodes of high inflation over the next 20 years. Okay, either that, okay, and by high inflation, I think it's very clear what I mean. Either that, or so either this case, or we are going to have chronically high inflation. Like chronically, we are going to have high inflation over the next couple of decades at least, right? By high inflation means it's not going to go back to 2% or 0% or 1% that we had over past whatever 10 years, 12 years, right? It's going to stay at 5%, for example, for next for most of the next couple of decades, most of the next 20 years, right? So again, this is the best case scenario. You could argue with a bunch of my assumptions, right? I just want to put this out and see what simple math is telling us about what inflation we can expect, how much inflation we can expect in next 20 years. You can see what the implications are for you according to this analysis. Thanks everybody. Have a good day. Thanks everyone. Have a good day.